Global markets look like they're throwing the party of the century. Stocks are soaring from Tokyo to New York. But here's the real question. Is this celebration built on solid ground? Or are we all dancing on ice that's about to crack? In this companion video to our weekly market update podcast, also available in French, Italian, Spanish, and German, we'll break down the hidden risks in the US, Europe, and Asia that could turn this rally into a sudden reckoning. And you'll want to stay with me until the very end, because there's one event this week that could change everything. Miss it, and you'll be behind the curve. So, hit like, tap subscribe, and share this with someone who needs to know what's really going on. Let's dive in.
All right, let's dive right in. You look at the global markets right now, and you'd think it's the party of the century. I mean, stocks are just soaring everywhere, from Tokyo all the way to New York. But, when the music gets this loud, you really have to start wondering, right? Is anyone actually looking down and seeing the ice cracking right under their feet?
And I mean, what a week it's been. Just look at this. You've got Japan's Nikkei up over 4%. That's huge. The Nasdaq in the US popped more than 2%. Even Europe's STOXX 600 is getting in on the action with solid gains. It really looks like a picture of perfect, synchronized optimism around the globe. But this is exactly where our story starts to get a little more complicated.
Which brings us to the big question, the one we're really digging into here. With all this celebration happening in the markets, is this rally actually built on solid ground? Or is it all standing on something a lot more fragile?
Okay, so to figure that out, let's first take a look at who's pouring the drinks at this party, right? What's the fuel for all this optimism? What's got investors so fired up? Well, it really comes down to two main things, two big engines driving this whole train. First, you've got this just relentless excitement about AI. I mean, we saw it just now when Oracle's stock went through the roof after they announced some massive new AI deals. But the second thing, and honestly, this might be the bigger one, is the hope, the expectation really, for cheaper money. Investors are basically betting the farm that central banks, especially the Fed in the US, are on the verge of cutting interest rates.
But, and this is a really big but, once you start to peel back the layers and look past those splashy headlines, you start seeing some pretty serious cracks in the foundation. So let's start our reality check in the world's biggest economy, the US. And this is where you see this huge disconnect. It's like two different worlds. In one world, the market is 100% convinced the Fed is about to cut interest rates. But in the real world, the economic data is screaming something totally different. You've got inflation coming in hotter than anyone expected at 2.9%. And at the very same time, the job market is really starting to look wobbly. And that strain isn't just a feeling, it's very real. Look at this number, 263,000. That's how many people filed for jobless claims in a single week. It's a near 4-year high. That's not just a statistic, it's a huge flashing warning sign that the super strong labor market we've all been hearing about for so long, it's definitely starting to fray.
So what this all adds up to is a massive, high-stakes gamble. Investors are basically betting that this weakening job market will force the Fed's hand, making them cut rates. And they're so focused on that bet that they're choosing to completely ignore the elephant in the room, that inflation is still stubbornly, uncomfortably high.
All right, now let's hop across the Atlantic over to Europe. The story there is kind of similar, but it's got its own messy political twist. The European Central Bank has hit pause on rate cuts for now, but underneath that, some of the continent's most important economies are dealing with some major headaches.
And maybe the biggest headache of all is in France. Check this out. The ratings agency Fitch just downgraded France's credit rating to A+. That's the lowest it has ever been. So what does that mean in simple terms? It means it just got more expensive for France to borrow money, and it's a huge signal that the experts are losing confidence in the country's financial health.
So why the downgrade? Well, a huge part of it comes down to this number, 121%. That's the projected debt-to-GDP ratio for France by 2027. Now, to give you some context, the official rule, the ceiling for Eurozone countries, is supposed to be 60%. So France isn't just bending the rules here. They're on a path to literally double the limit. That's a big, big problem.
And the worries don't just stop with France's debt. You've got political gridlock in Paris that's making it almost impossible to get anything done. Then you look at Germany, Europe's industrial powerhouse, and its exports to the US just fell off a cliff, down almost 8%. And if you pop over to the UK, their economy has just stalled, flatlined, 0% growth in July. It's a worrying picture across the board. Okay, let's shift gears and head east to Asia. Because over there, the big market rallies in places like Japan and China are hiding a whole different set of problems. We're talking about everything from political turmoil to this stubborn, dangerous fog of deflation.
And what's happening in Asia is really a tale of two very different giants. On one side, you have Japan. They've got a huge political shakeup going on, with the prime minister resigning, but, and this is the surprise, their economy is actually doing pretty well, with GDP revised up. Then you look at China, and it's almost the mirror image. The stock market is rallying, yeah, but it's mostly driven by regular retail investors. And all of this is happening while the economy is stuck in this deeply concerning deflationary spiral for 35 months straight. So really quickly, what even is deflation, and why is it such a bad thing? Well, it's the opposite of inflation. It means prices are consistently falling. Now, that might sound awesome, right? Cheaper stuff. But for an economy, it is an absolute nightmare. Think about it. Why would you buy something today if you know it'll be cheaper tomorrow? You wouldn't. So people stop spending, company profits dry up, and the whole economy can get stuck in this vicious downward cycle. Okay, so let's put all the pieces together. We have a global market party that's running on pure hope and optimism, but underneath, it's being seriously undermined by major economic and political risks in the US, in Europe, and in Asia. And it feels like all of these tensions are about to collide in what could be a real week of reckoning. So as we head into this make-or-break week, there are basically 5 big risks that could bring this whole party to a screeching halt. Number 1, the Fed disappoints the market. Number 2, France's debt crisis gets even worse. 3, we see new signs that the U.S. consumer is cracking under pressure. 4, stubborn inflation from the UK or Japan forces other central banks to stay tough. And finally, number 5, China's deflation problem deepens, scaring everyone about global demand. But look, out of all those risks, there is one event that towers above everything else. If you're going to pay attention to just one thing this week, make it this: the U.S. Federal Reserve's interest rate decision on Wednesday. That is it. That's the moment of truth. This entire global rally is basically one giant bet on what Jerome Powell and the Fed are going to do. So, the market has placed its bet. All the chips are in the middle of the table. They're betting big on one specific outcome. And the only question left now is, will that bet pay off, or is this party about to come to a very, very abrupt end?
If you found this breakdown useful, hit like and share it. It helps more people discover MacroNav. And if you want more clear, no-nonsense explainers on global macro and finance, make sure you're subscribed. Stay ahead, stay informed.